Please welcome once again Anuj Singhal back on the stage. And now please give a huge round of applause to three of the sharpest equity minds in the country who will take that on. Rahul Singh, CIO, Equities Tata Mutual Fund. Ramesh Mantri, CIO, WhiteOak Capital Mutual Fund. Trideep Bhattacharya, President and CIO, Equities, Edelweiss Mutual Fund. And Shridatta, Bhandwaldar, CIO, Equities, Canara, Robeco Mutual Fund. Thank you to our speakers and, of course, welcome them.
Well, the topic is markets in consolidation mode, where to find alpha. Of course, one alpha you can find on Friday, the Alia Bhatt movie releasing, but we are not talking about that. We are talking about the real alpha that all of you have mastered in generating. Now, let me go through an opening line which I want all of you to remember, because towards the end, I'm going to ask you a question which is related to that. The opening line that I've written is that now for 4 years, investors have bought every dip, and especially in the last 2 years, the dips have become deeper and deeper, right? And what has happened is that the market feels very different, right? Index returns have been quite abysmal, and valuations are still elevated despite all the underperformance, and stock price picking is back. So has investing become harder, or is this finally the market which the active fund managers like all of you have been waiting for? So just remember this, and I'll have a question towards the end. So Rahul, let me start with you. Where will alpha come from in this market?
So alpha, actually, our view is alpha always comes from growth. Now, today the growth is in power, bits of healthcare, and that's where the alpha is coming from. And definitely not in IT. It's not growth is not in IT. Banks, I think growth is coming back. With some triggers in place, I think growth will come back. So I think you have to, and some pockets of consumer will always have alpha. There will always be some pocket, some sub-segment of consumer which you can use to generate alpha, and that's the beauty of consumer sector. But barring that, alpha will always come from growth. India is a growth market. We can try playing value. There will be some pockets of value you can keep in your portfolio. But if you're lucky, you will generate alpha once in 2-3 years from value. But on a sustainable basis, it always comes from growth. And you have to, keep your eyes on which sector, which companies within the sectors or companies outside or independent of the sectors are driving growth, which are beating not just GDP growth rate, but your peers' growth rate. And that is where we have seen sustainably valuation getting re-rated, maybe getting excessive at some point of time, and you have to be, you have to be smart enough to realize when that happens. It's not easy, and we always forget when to sell some of those names. But that's where I firmly believe alpha is going to come from.
Okay, Ramesh, what kind of market do you prefer? There was a market in 2021-22 where perhaps your stock picking ability could be worse than your peer and you would make more returns, versus the market right now where the index is not generating anything, but beneath that, if you have picked right stocks, I mean, some of the returns that we have generated in stock-specific moves in India are at par with some of the big markets that we've seen, whether it's Korea or US. Your thoughts?
No, as an active manager, strong trending one-way markets where everything goes up is actually difficult for us, because in fact we like to balance risk and reward, and that's a phase of the market where only risk gets rewarded. The sweet spot for us is these kind of markets, whereas an active manager, the right balance of risk and reward matters. And so actually I absolutely love this kind of market.
Okay, and do you think in this kind of market you will be able to generate, say, 15% returns? And by the way, by 15% I mean per year, yeah? Because in 2021, investor expectation had gone up to 15% per month. We have left those markets way behind. So now, will you be able to generate those kind of returns?
See, I think over time, longer term markets tend to deliver nominal GDP growth, which historically in India has been about 11, 12, right, long term. I think if you add a few percentage points of alpha and active manager, you can end up with 15. But that's also effort. I don't think we have any birthright to get 15% per annum. But markets cannot at aggregate deliver 15. Markets over longer term will only deliver, let's say, 11, 12%.
Actually, that is my question. Trideep, if let's assume we get 12% earnings growth, in that case, can you still deliver 15% CAGR? Because that's what I'm paying you my money for, right?
Indeed. I think earnings growth is one. Picking the stock at the right valuations is the second. For instance, India has always been a stock picker's market. Even in a sector like IT, which has gone down significantly, I can name 2 stocks which are up about more than 30%.
Yeah.
So, and it will continue to remain so. So what we need to find is the pockets of those growth. So one, for example, at a very broad level, if I may say so, India seems to be changing the pivot from services-led growth to a bit more towards manufacturing. Now, in this transition, there are many pockets which are currently there, many pockets which are developing, and many that are about to come, which will present, in my opinion, strong alpha opportunity for investors going forward, far in excess of the number that you sort of, talked about. So I would say that, the alpha opportunities are, plenty even in the current so-called, as you call it, flattish market. But even in CY25, which you call as tough market for India, broader markets gave you 10% return, which is not a bad number to start with.
Absolutely not. It's just that the expectations got elevated post-COVID, and that's where, Shridatta, a lot of new investors came in, they saw the markets, and they thought markets only go one way, which is up. But things have changed. Have investors' expectations come down? And what's your sense? What kind of returns can one expect, say, with a reasonable 4 or 5 year time horizon?
I think first of all, earnings come in cycles and the returns come in cycles. I think most of the time, and this is not true about only equities, this is true about actually all asset classes, just like what you saw in gold, you saw in small caps. In every asset class, there's a cycle where either the underlying cash flows come and you get the returns. If you actually step back and start thinking about what happened in 24, everybody thought that while our long-term earnings potential is 11-12% at aggregate level, like what Ramesh said, but everybody was assuming that the 18% CAGR between 20 to 24 is our birthright. I don't think that is going to get repeated. But at the same time, I would be far more relatively constructive today because we have had tapering down of expectation of earnings. I'm not so much worried about valuation. As long as earnings actually recover, I think we'll go towards that number that you are speaking about. At portfolio level again, not necessarily at market level. And I see there's a good chance of that happening because the earnings estimates across the board have been tapered far more today, except mid-caps probably as asset class, as compared to where it was, say, a year back or 2 years back. So that's how actually we are looking at it.
Okay, how many of you here have seen their portfolios go up by 20% in last 1 year? Be honest. Not a single one. And how many of you have seen a degrowth in your portfolio value in last 1 year? There are only 5 honest people in this room. I'm sure a lot of you would have lost, but maybe don't want to accept it. Okay, now, the next part of question, I'm going to divide it in 2 parts. First is where you are worried about the consensus, and second is where you think everyone is ignoring a particular space. Ramesh, let me start with you. Which is one consensus which worries you? Biggest consensus trade that worries you right now?
So I think there's a lot of interest in this AI-driven investments in India, whether it's industrials, whether it's power and all, right? You're trying to catch an AI story in India. Reclassify every potential company as an AI company.
Yeah.
So that is, and that's a global risk actually, what is happening to the whole AI complex. If that changes, that's probably the biggest risk to a part of the market. I think the part of the market that will surprise in India, I believe, is a potential is consumer. It's been out of favor for quite some time. We had income tax cuts last year. We had GST cuts. That, in fact, the March quarter was actually the best quarter for consumer companies in a long time. But of course, again, it got saddled, the Iran conflict.
Because of war, yeah.
But I think consumer stocks have corrected.
Because of the GST cut, the impact of the GST cut?
No, it's actually a lot of recovery, even in sectors which are not benefiting from, because see, income tax cut came in, That also came. That has nothing to do with GST at the start.
Absolutely.
I think they initially did not see the benefit because the money till January went into gold and silver. Everybody put their money into gold and silver. The love for gold and silver got over in January. And then I think the money started now flowing to consumer.
Absolutely. A lot of us have actually forgotten that there was a income tax cut in budget. So much has happened in last 12 months. Shridatta, same question to you. One consensus trade that worries you and one opportunity that you think the market's overlooking.
I think clearly industrials, which is quasi-AI trade. Not, while I agree with Trideep that generally movement from services to manufacturing is playing out, but in this particular space, 3 years back, people are not willing to believe that companies can make 10% margin. Today at 25% margin, people are willing to believe that this is going to sustain. So I think we're completely on the other side in terms of valuation, the earnings estimates, the margins where the companies are sitting, and on top of that, the ownership. Because even the FIIs have actually in India, if you look at the data, net sold the sectors which are out of favor, and they have actually bought industrials over the last 3 months. And I think that's one sector which clearly worries me. While we like it fundamentally from a long-term perspective, but near-term clearly there are going to be significant disappointments in my view. So that's on the risk side. I think opportunities, clearly two spaces. Financials, I think people are still underestimating that the credit growth is running at 15% for several months now. So at least for few of the financials, particularly the private banks as well as large diversified NBFCs, is clearly going to reflect in terms of growth surprises. That's how at least we are looking at it. That's one space. Second space, like what Ramesh said clearly, every single time there has been tax cuts or basically consumption spent by government, state governments plus central government. If you go back 20 years, every time the first sector always has been beneficiary, has been part of consumption, which is auto, and then it has percolated into the other sectors. While it has started percolating, the numbers have started actually improving at the margin, but because people are completely enamored by the other side today, I think a lot of people are kind of completely ignoring the part of consumption.
Okay.
Part of it is tactical, probably FMCG, but consumer discretionary, I think as a space is something which is more structurally now.
Okay, so the gentleman on the left basically agree on both the points. Rahul, what about you? What's one consensus trade that worries you and what's one hated space that you would like to get into right now?
The hated space I would like to get into is insurance because I think there's just too much of negativity around what kind of regulations will come, what it will do to growth, what it will do to profitability. But if you look at insurance companies, I think they are on the right side of whatever regulations will come. As manufacturers, I think their profitability and growth might actually get a lift up. So that's clearly one sector. And it's also like banking, it's also at the bottom end, I mean, at the 2 standard deviation below the mean kind of valuation range. And in terms of what consensus trade worries me, although I like the sector and I mentioned that that is where growth seems to be coming back, it's still a big consensus and big holding for all of us is banking because it worries me because it is so consensus now and it is an over-owned sector. So my worry is more from a technical point of view, not from a fundamental point of view.
Okay, but if banks don't move up, the markets won't move up. So
exactly, but you have to worry about it.
Okay.
As a portfolio manager, if you don't worry about it enough, you'll not be able to manage it well enough, I guess.
Oh, absolutely.
And I think that is why you have to worry, even though I am optimistic. So you have to manage both sides of your brain to be able to manage, because that's the kind of market we are in.
No, absolutely. And I think it's quite brave of you to say that about the biggest sector. Trideep, what about you? Same question.
So I would say, within financial services, wealth management and asset management in terms of overall future opportunities for investments is something that I see as undervalued versus what the potential is over the next 5 to 10 years. And I would also put in that the same bucket, export-oriented manufacturing, which has got completely smacked on the back of this trade deal or lack of it, are the 2 areas that I do see value coming in with versus where we are. Where I see risk is basically the new age consumption, where, I think people are betting too much on growth versus the lack of focus on profitability. And, every day somebody announces some sort of policy, and on the back of that, some of these consumption stories go up as though there is no gravity. So those would be 2 bottom-up specific, India-specific areas.
That's a lot of meat that all of you have given me. Now, let me ask one question to you, Trideep, and let me start this round with you. When you're buying stocks, are you buying narratives or are you buying numbers? Are you buying narrative or are you buying numbers? I mean, do you buy a great promise or do you wait for the company to deliver the numbers first before buying? Because we are talking about generating alpha.
Yeah. So I buy my ability to understand the earnings power of the companies 3 to 5 years hence, and at the moment I buy into the disappointment that they have probably not delivered in the near term. So it's basically a time arbitrage which I am looking to play, which is the current disappointment to future delivery of number at some point, which will come on some or the other. A different framework probably, but related to what you just asked.
Absolutely. Rahul, I was reading a quote today and, it struck me. So let me ask you, do you buy a great company at a fair price or a fair company at a great price?
The first one. Great company at a fair price.
Okay.
I think the second category used to be a very potent source of wealth creation during Ben Graham days, where there was enough, little or less probably, markets were less, efficient, and you could find those valuation anomalies. These days, you have to understand the earnings driver going forward for you to find value in it, which is why a great company at a fair price.
Sure. Rahul, you want to answer that as well?
Yeah, I mean, obviously great company at fair price if you can find one in India especially, very difficult. But you get dislocations in the market, and you have to take advantage of that. But I will connect it to your previous question also, whether you buy narrative or bottom up, because that's a very important question. And it's like the Hindi movies में बोलते हैं ना, कहानी की मांग. So कहानी की मांग, if I'm running a business cycle fund, I will give more credit to narratives.
Okay.
Right? If I'm running a business cycle fund, and I can even buy a basket of, say, power companies. Okay. If I'm running a small cap fund or a bottom up, any other bottom up fund, the narrative becomes relatively less important. The bottom up becomes more important.
When you're buying narrative, for how long do you wait for the numbers to come up, or do you give them a fairly large rope?
In narrative companies, what happens is that the valuations move up before the numbers move up. So most often than not, if you've got the narrative right, then you will end up selling, or you'll end up at least booking profits before the numbers actually come. If you get it super right. I mean, if you get it really hit the ball out of the park. But if you are wrong, then you have to realize fast enough, which is where the bulk of the struggle is, to realize when you are wrong and how long do you wait. And I think it is true for stocks also, not just narratives.
Okay. Ramesh, now interesting question that I want to ask you. In this kind of market, do you go for a concentrated portfolio or do you go for a diversified portfolio?
See, okay, I'm very clear, India provides large investable opportunities and the market opportunity is growing. Every IPO in India creates a new small cap. Even if a large cap IPO happens, it creates a new small cap. So I think the universe is growing. The variety of investment opportunities that exist in India are growing. 7 years ago, there was not a single AMC or a wealth management firm listed in India. 8-9 years ago, there was not a single insurance company listed in India. There's so many sectors yet to go public in India or going public in India. So the universe is expanding. Some of these companies, when they start, they have to start small because nobody rarely starts big. So, and many of these opportunities, you cannot deploy a lot of capital even if you want to, because as of now, the opportunities are small. But I would still love to invest in those opportunities because when they become successful, they'll become bigger companies. So the right answer is clearly it's a bottom-up investor. I would love to have more concentrated portfolios, but there's so much opportunities that we end up with a diversified portfolio.
Okay, that's a good one. Shridatta, if someone is starting investment journey now and has horizon of 5 years, right now, what is more important to you, valuation discipline or earnings growth? I mean, would you pay more valuation for companies which are growing at a much rapid pace, or would you rather stick to valuation comfort in this market?
No, I think it's never black and white. It is a combination of both these things. So I'll give you an example of both the things. If the opportunity pie is very large in a particular segment and it is expanding, of course you have to upfront pay a little higher. Okay. And there are businesses which are traditionally well understood, mature businesses, where of course you have to always go for valuation comfort. So that's a combination that you have to work with. From investors' perspective, I think he shouldn't get into this. He should just focus on, like previous panel was saying, that somebody who has been more disciplined in his asset allocation in any part of the market, he has made enough money. He has been disciplined in his behavior rather than what fund managers are doing. So I think that's the way to look at this.
Rahul, India is one of the few markets where actively managed funds have beaten passive funds, some of them by good margin. Do you see that continuing?
It is not easy. It's not easy because the market breadth has increased. So Nifty 500 becomes extremely difficult benchmark to beat. But I think as the dust settles down and as the valuation frenzy kind of goes up and down, settles down, over a 3-year period, it's much easier than over a 1-year period, is how I will put it. And even large cap category, I was looking at performance, including ours. We've been able to beat even in large cap. So this whole debate about that you can only beat it in small and mid and all that is, I think, little bit of overdone logic. I think large caps also managed with little bit of a good mix of contra and compounding kind of companies mix. I have seen a lot of portfolios able to beat benchmark in the large cap segment also, which traditionally belief is that you can't beat large cap. Nifty is the best. Nifty index le lo, and I think that does not work.
Okay,
not always.
Okay, Trideep, a tricky question. These days we have 25-year-old kids using cloud and chat GPT, uploading the PPTs of companies, the audio presentations, YouTube interviews, and generating handsome returns because the AI is giving them information that earlier perhaps was only with fund managers. Do you see that as a bit of a competition?
No, actually. I think what's happening is, earlier, as I said, investing is all about having an arbitrage. So earlier there was information arbitrage, which is what AI is actually cutting down to practically nil. But at the same time, there is something called an insight arbitrage, which comes from basic understanding or fundamental understanding of the sector or the earnings power of companies. And that comes after years and years of research. And I think true alpha, which is sustainable over a period of time, can only be generated if you have an insight arbitrage over majority of the players in the market. Not insider information, but insights coming from industry trends or company-specific trends. So I think that bit, AI for sure, is something that won't be able to take it away. I'm fairly confident over a period of time. The other part, which AI might not be able to take away, is the greed and the fear. And I'm yet to see an accurate model of greed and fear developed by any sort of, howsoever bright the kid he is and whichever school he went to. Till that time is there, I think as portfolio managers, we still have our jobs.
Oh, absolutely. And I hope we too as well. Okay, now, Ramesh, is this finally a market where valuations or rather fundamentals matter? Because we had gone through a period where it was all about liquidity.
No, I think the liquidity dynamic anyway has changed, right? With FI selling, it's more now local money that's sustaining the market. And we had this post-COVID a strong euphoria in markets and all. But now we are more focused on fundamentals. See, there was a period I've seen for a few years in India after COVID. So companies would report bad results for sustained time and the stock wouldn't correct. Now it's actually changed. Now markets are actually responding to earnings and fundamentals. So I think that way it's a far better market now where you will get rewarded and punished both depending on the fundamentals. So that way we are in a more sustainable market.
Okay. Shridatta, what's to your mind, the biggest risk right now for investors? Is it local or global? The market has gone through a lot and it's still not corrected. I mean, it's seen a time correction, but still not seen price correction.
Well, market has not, see, risks are always both, global as well as local. But risk has always been around. It's not as if the risks have not been there. And the biggest risk, I don't see macro or micro or global or local as a risk. I see a lot of investor behavior as a bigger risk than actually the global or local risk, because a lot of people over last 3-4 years have gotten into this feeling that if you come to equities, it means you are guaranteed a 15% return or 20% return. And I think that is misplaced, because ultimately earnings have to play out. Thankfully, this year I'm seeing lesser risk than last 2 years, because one, the valuation exuberance is far kind of moderated. Second, the supply is keeping the market in check. Third, clearly while market is ignoring today for last 2 quarters through tariff related stuff as well as war related stuff, we are clearly seeing more number of companies beating the earnings estimates. Earnings have already, for even Nifty 500, already moved to 12%, 13% last quarter, which is a very, very healthy sign. So I'm seeing more opportunities today as compared to last 2 years than actually a threat or a risk. Risk is clearly, I mean, in terms of how investors have behaved for some time. But this is true about, I mean, it's always true. Like even in gold, people did the same thing.
Okay, one word answer. I have a sentence. There's a fill in the blank, and you have to fill the blank. Ramesh, let me start with you. The next multi-bagger will most likely come from?
Consumer.
Shridatta? Same question.
I think consumer.
Consumer.
Healthcare.
Healthcare. Healthcare is
Healthcare as in not pharma, but healthcare.
not pharma, exopharma,
Yeah.
diagnostic hospitals, all these chains.
Export manufacturer.
Export manufacturers. Care to be a bit more specific?
Indifferent. It could be in, it could be
Textile?
Textiles or auto ancillaries or whosoever, maybe, industrial manufacturers, multiple of them.
Okay, so as I said when I started the show, I'll go back to my opening line. And if we meet 5 years from here and we are doing the 10th Moneycontrol Mutual Fund Summit, my opening line were that for nearly 4 years, investors have bought the dip and they have not been rewarded. What would most likely be my line 5 years from here? Rahul?
5 years from now, I think the line would be that if you the investors I think kept on I think investors stopped at the wrong time adding, and that is when the market started moving up.
Okay.
That would be my line.
Trideep, what would be your line?
Earnings are non-linear. I'm glad I bought the dips because it caught up in the immediate last 5 years.
I'm glad that I didn't exit the market, right? That could be one as well. Ramesh, what do you think?
Equity is the best asset class in India.
Equity is the best asset class in India. Shridatta?
I think I agree with Trideep that basically earnings have been sidelined for last 2 years. So I wish I had bought at that point in time rather than worrying now. The worrying was last 2 years. Yeah.
How many of you believe that even after the last 1 or 2 years, equity is the best asset class in India? Okay. So looks like the bottom of the market might still not be done. If we go purely anti-consensus, right? But anyway, gentlemen, thanks a lot for your time today. It was a wonderful conversation. I hope you liked it. And please, once again, a round of applause. Thank you so much. And you've been a great audience. Thank you to you as well.
All right, thank you, gentlemen, and of course to Anuj for steering that conversation. And of course, that was the final conversation of this evening. And that brings us to the end of this. And HDFC Mutual Fund presents Moneycontrol Mutual Fund Summit 2026.